Good afternoon. I'm going to take you through how we look at our reported returns in the hotels and restaurant business and how some of the insights from the analysis of them help drive our management actions. From this chart, you can see that hotels and restaurants produce a good return on capital that has increased from 11.5% to 12.9% over the last 5 years. These returns have given Whitbread a strong financial position that in turn provides us with a real competitive advantage to have the choice to expand through both freehold and leasehold properties. With the recent announcement of our 2018 milestones, we will continue to maintain this focus on strong returns to deliver shareholder value and ensure we are in balance to fund this growth. However, as we grow, the mix of our estate will change, with a majority of the existing pipeline coming from leasehold properties. It is therefore important that we understand the impact that this change will have on our returns. Currently, 69% of our estate is freehold, where we own the land and buildings, giving Whitbread a strong asset-backed balance sheet. This is our preferred ownership structure, as they provide us with both financial and operational flexibility. The financial flexibility enables us to retain the site development profits and the added value from extensions and investments in refurbishments. They capture the value of the operational improvements in our business rather than passing a share on to landlords and help avoid inflationary rent. They also provide the flexibility to recycle capital from mature properties into new freehold opportunities through sale and leaseback transactions. Over the last 3 years, these benefits have led us to invest roughly £340 million in new freehold properties in the UK. The operational flexibility freehold provide us include enabling us to add extensions once the original site matures. Extensions have been a consistent source of around about 1% like-for-like over the last few years. However, our expansion plans have increased focus on city and town centres, where freehold opportunities are harder to come by and leases are often the only option. As a result, 74% of our current pipeline properties are leasehold. Although this will reduce our freehold mix, it will still be a significant majority of the estate at roughly 62%. This shift in the property portfolio in turn changes the shape of the hotels and restaurants' profit and loss account. Looking back over the last 3 years, you can see that the EBIT-DAR percentage margin has remained relatively flat. However, as we've added leaseholds to our portfolio, the rent has increased from £48 million to £70 million, which in turn has reduced our EBIT margin percentage by approximately 1%. As we continue to grow, the economies of scale from our central support functions, costs, and the reducing proportion of lower margin immature rooms will significantly offset this margin reduction in the future. To understand the impact of this change in the estate, we look at the returns we make on our freehold and our leasehold properties, both together and separately. Now let me take you through this in a bit more detail. This chart shows the return on capital at site level before central overheads. From this, you can see our total site returns on capital have increased from 16.8% to 17.2% year on year. Just to give you an insight into how we analyse returns, let me briefly explain the movements within this improvement. Firstly, the like-for-like freehold returns were constantly strong at circa 18%, and leasehold returns improved around 2% year on year as the estate matured. Secondly, the higher mix of less capital intensive leaseholds also benefited total returns year on year by approximately 0.4%. And finally, partially offsetting these improvements was the effect of the new openings, with a higher proportion of immature new rooms reducing total returns overall by roughly 0.3%. It's worth noting that the like-for-like leasehold returns were impacted by the goodwill on historic acquisitions going back over several years. Excluding this, the leasehold returns would be approximately 10 percentage points higher. To really ensure that we continue to understand the value that both freehold and leasehold give us, internally, our investment appraisals review each new site proposal on their forecast net present value, internal rate of returns, return on capital, and capitalised lease returns. We also look at returns under our two business formats, the joint sites and our solar sites. In this slide, we have broken out the solar sites into pure solar sites and co-locations where the restaurant is run by a third party. From this, you can see that the joint sites and the pure solar sites have comparable good returns pre-central overheads at around about 18%. This reinforces the competitive advantage of having the two formats and the importance each plays in Premier Inn's network, the solar sites in city and town centres and the joint sites in smaller regional catchments. You can also see the impact of the WHR overheads and advertising costs of 106 million on our returns. Last year, we invested some of our return improvements back into our central overheads and advertising to drive future growth, increasing our advertising spend and the capabilities within the digital and dynamic pricing team, together with building a more focused restaurant management team within WHR. Going into a bit more detail on joint sites, Paul Floam will later talk about the advantages that they give our customer. When looking at their performance, we primarily look at the overall site performance. However, we also do make a proxy for the contribution restaurants and hotels make towards the joint site. We do this by looking at the direct costs of food and beverage and, where possible, the dedicated labour. The chart shows an average mature site between 5 and 10 years old of about 55 rooms with an overall return of 17.3%, not far off the overall joint site average. From this, you can see that at this level, both the hotel and the restaurants make good contributions to the joint site's strong returns. A Solus Premier Inn of a comparable size, without the economies of scales they get from the restaurants, would struggle to be economically viable. Later in the afternoon, we will explain the new room milestones to 2018 and the exciting opportunity that London, and particularly central London, provide. As 74% of our total pipelines are leaseholds, this slide shows the indicative economics that we might expect from these pipeline rooms in London and compares them to those in the regions. Starting with the RevPAR we achieved last year from our current leasehold rooms, you can see that central London's RevPAR of £86 compared to £38 in the regions, equating to a revenue per room of £32,000 and £14,000 respectively. As we think about our leasehold pipeline, we know that the central London rent is approximately double that of the regions. If we maintain double the RevPAR compared to the regions, this would also lead to double the EBITDA pre-overheads in central London of £9,500 to £11,500. I must caveat that today we have a small sample of rooms in central London, so these are indicative, and it is early days in understanding the impact of the economics as we continue to grow in this market. However, you can see why we see the exciting opportunities in the future. The increased granularity of analysis and returns in the business is being used to drive actions, such as the increased focus on restaurants and the Premier Inn profit drivers, such as digital and dynamic pricing and the efficiencies of regional cluster management that really help drive returns at site level. Going forwards, we will continue to use this approach to create value. In the short term, this is driving greater focus on our overheads with clear accountability and a re-engineering of the cost base with a reduction of £10 million of gross costs over the next 3 to 4 years, and ensuring that the investments we made in central overheads last year go forwards to deliver strong returns. Finally, we have a rigorous post-capital review process where quarterly we look at the sites as they mature over 4 years. We focus on the RevPAR, the maturity curve, and the returns to ensure they are in line with our expectations. Learning from this process, such as the strong returns in London, the maturity rates, and the site economics and the effect of competitor openings, are then fed back into the appraisal process for future investments. The insights have also been a fundamental driver behind the hub, whose economics provide good returns, as we will cover later. So in summary, we are focused on returns, and this focus and the insights we are gaining are ensuring we take the right actions to firstly, organically fund our milestones, secondly, retain a strong balance sheet, and finally, to deliver good shareholder value. I will now hand over to Simon Jones, who will take you through the network growth opportunities.